Okay. All right. So the plan for the rest of the night is we're going to spend probably an hour talking about FIN 48. So when I say FIN 48, I mean, what we say here is step 5, accounting for uncertainties. FIN 48 was the way it was referred to before ASC 740 was out there. ASC 740 has been around, the whole ASC codification has been out there for, 4 or 5 years probably now. But if you talk to people like my age, no one refers to ASC 740 anything. They refer to like 109 paragraphs or FIN 48, or 141R is like the purchase accounting rules. People still completely, almost unequivocally use the old guidance as the cites, even though the old guidance doesn't even really exist. It's just kind of the terminology out in the workplace. And FIN 48, more than any of them, has kind of brand name to itself. So think of FIN 48 as a subset of ASC 740, but it is all the rules within ASC 740 that deal with uncertainties, okay, exposures. Make sense? So we'll spend an hour talking about that, and then there's going to be one in-class problem that we'll do. And then we'll spend the second hour going through valuation allowances. So again, we'll talk about concepts, and then we'll do a couple problems. And then with the remaining time that we have, we'll go through the case study that you should have worked on last week, and we'll just kind of go through the answers. And if you saw in the materials that Anna sent out today, the beginning of tonight's deck was actually the answers to the case study from last week. So the first 20 or so pages of tonight's deck was actually the solution to the last 20 pages of last week's deck. Okay, and that's kind of what we'll do the next class as well. Sound good? Okay, tax exposures. Okay, so I mentioned this when we were talking about the Cadence 10K. Before FIN 48 came around, boy, it was really inconsistent how companies accounted for exposures, and disclosures was a big deal. So like I said, before FIN 48, there was almost no required disclosure. Disclosures were usually very short. And whether a reserve was booked or not, it was just subjective. It wasn't clear in terms of, you could take two companies with the same facts. One might book a reserve, one might not. And the FASB sat there and thought, this is not good, right? We need to be more prescriptive with how we define how to account for exposure, so companies are more comparative. So they created all these rules to try to do that, even though there's still a lot of subjectivity still in the in kind of the field of play on the topic. So keep in mind that the reason the rules changed were more disclosures, more consistency between companies, and given a set of facts. This is kind of the same thing. If you went back and really looked at the way tax accounting was done, even pre-SOX, if you ask somebody that's been around 20, 25 years, they will tell you that tax reserves used to be kind of a slush fund, right? And when I was a like full head of hair, young, like bubbling, aspiring kid, and I was like 25, I worked for this one partner at Deloitte that is long since retired, and one of his catchphrases was, "You never go to jail for having too much cushion." And you could never say that now, right? And but that just shows you how times have changed, right? Back in the mid-90s, if you had this big reserve sitting on your balance sheet, well, that was like a rainy day fund, right? If some exposure popped up, you'd be like, oh, I got a reserve for that. I didn't know I had a reserve for that, but I had a reserve for something, right? So the whole concept of earnings management, boy, there's very little room for that at this point. But in the most kind of extreme case, I suppose you could say that FIN 48 put that to rest by just making the rules very detailed. Okay? So these are some of the key themes with FIN 48. FIN 48 only applies to income taxes. So if you have sales tax, not an income tax, not FIN 48. This class is only about income tax, so it's relevant to us. The FIN 48 rules created two key steps, or I guess thresholds you had to get past, or rules that you had to apply. And the first one is called recognition. And what this rule basically says is if you take a position and you're not at least more likely than not to win, you got to reserve the whole thing. Okay? So if you take a position where it feels like you're just speculating, you're trying to be really aggressive, just reserve the whole thing as if it's entirely a loser. Okay? So that's the recognition test, meaning if you fail the recognition test, you reserve 100% of the position you claimed on a return. If you claimed an R&D credit of 100 and you said, I'm going to lose, but I might as well give it a try, you reserve the whole 100. Okay? You don't say, well, I might win 20 or something like that. You just reserve the whole 100. So if you get past the recognition test and you decide, okay, well, I think that I'm going to win, right? Then you move on to the measurement step. So take that same example. I take my R&D credit of 100, and I think I'm going to win. I think I do R&D. It seemed like I passed the test, but I know these things are like notoriously hard to deal with taxing authorities, so I might have to settle. And if I claimed 100 of credit, by the time I'm done with my auditor, I might walk away with 80. And so what the measurement test tells you is you should accrue a reserve for 20. Okay? And rather than focusing on the way in which you should book a reserve, meaning book the liability, the rules are all phrased around booking the asset or booking the benefit. So in that example that I just gave you, the rules would say, okay, book the 80 as a benefit, but don't book all 100. So implicit in that would be that you need to book a 20 reserve. Right? And this is a little confusing, but the guidance is focused on this benefit concept. But when you get kind of down to just how to be practical, think of that example. So if I'm taking, think of a journal entry. If I take a debit to tax payable for 100 because I'm going to claim a $100 credit on my return, but I think I'm going to lose 20 of it, I'll book a FIN 48 liability of 20. So that's my net benefit of 80, and I'll credit my provision of 80. And I'll say the benefit I'm going to book is the 80, which is the amount that I think I'll sustain through the measurement test. So most people, when you're talking in practice, will say, well, what's your reserve? Right? And they'll even phrase it like, well, how much of your R&D credit do you reserve? And it'll always be, well, I book 20% reserves on my credit. I mean, that would be a typical conversation. No one would come up to me and say, well, how much of your benefit do you book? I mean, but that's just the difference between the guidance and practice. Grant?
So the question is how this works in companies or CPAs or such. When you're working with the company and you're coming to that point where you're trying to decide to make the decision to book or not. Is the tax research usually done on the front end, like you already built the case, like this is what we'll argue, or is it something like, well, it doesn't go to that extent, but we'll figure it out if we have to go there?
So I think what you're asking is, do you have to go through this exercise for all your positions, or do you kind of wait till trouble starts brewing?
Yeah, I'm just kind of like, you know what, if we feel good, we've gone to the extent of researching, knowing our position, knowing what case law or whatever we might need to go to society or be able to take this position, to be able to get that feeling of, okay, we feel more likely than not that we'll actually be doing okay, but and then now we can actually take this, an idea of we're going to get 20, we have to pay 20 of this back or not.
The answer to that just differs based on every company and their positions.
I was wondering as far as like tax departments, if that's what kind of people, some people might be doing or something like that.
Tax departments at bigger companies, so for example, like Tracy last week, so she's taking positions on a return in her position. It will be second nature to her to think through these FIN 48 tests for everything that they do. And instinctively, they'll be able to say, oh, well, that R&D credit, we kind of know how to deal with that from a reserve perspective. We have a policy. We've been through audits. We kind of have an approach. It may not be a stressful thing. Or she might say, oh, well, we just took this kind of unique position. It's one time. It's different. We've never done it. It's controversial. We might write a memo. We might have to talk to our auditors, get on the same page. There's a bit of a vetting exercise. That's typical. This afternoon, I spent time with a bunch of PwC guys that are auditing one of my clients. We did the exact same thing. We sat in a room and talked about the position. We talked about the steps, where we're going to come out on this, and that's typical. So you be very proactive on this topic. This is not a reactive subject. Okay, so key themes are you gotta have a position you think you're going to win on, and then even if you do think you're going to win, now's the time you sit back and you use judgment about how much you think you're ultimately going to walk away with at the end of the day. That's kind of the key themes. Okay. All right, so we will walk through these steps, but in theory, there's kind of a process that you can go through from, starting with identifying the positions you need to evaluate, assessing your need for exposure, and then ultimately going through the whole disclosure, interest, penalties, the whole thing. Okay. So, step one. So the first thing you need to do if you're a company is you've got to figure out all the positions that you claim on a tax return that you think you need to apply these rules to. Okay? And so with Cadence, remember at one point they had like $300 million of tax reserves. And you don't know if that's one position or it's like 300 positions. Right? But somehow they had to determine, well, what things have we done or we're planning to do that we need to consider FIN 48 for? And the technical rule is you're supposed to look at all your positions that are not highly certain. And highly certain is things like slam dunk, I wouldn't even talk about an exposure. It's just the way it is. It's the rule, I deduct it, end of story. And so in theory, the population of positions you're supposed to analyze is broad. Right? My transfer pricing is kind of, judgmental. My R&D credit is definitely up for debate. I took a deduction for this thing that might be lobbying. I didn't file a state tax return because I didn't feel like it. There's a lot of things companies do that they can be second guessed from an exposure perspective. And the theory of FIN 48 is you're supposed to evaluate all of them. Okay? And you can imagine that a big company would be like, okay, that's a lot of work. And that's reality. I mean, FIN 48 is time consuming, and when you look at a big company's documentation, I mean, it would be thick. This is not like a thin exercise that is ancillary to a big effort. This is part of a big effort. I'm going to skip unit of account other than to say, once you've identified positions, it's possible that as you go through FIN 48, you should take a position and segment it into little subsets. That, when you read the guidance, would say that's how it works. But in practice, very rarely do people segment their positions. So a simple example of this would be I take an R&D credit and the IRS might come and audit me, and they might decide that they're going to pick on me because I have execs in there, and then I also have some amount of my R&D staff that's just turning my computer chip from the color blue to color red, and that's not a qualifying expense. So those are kind of two different positions that have nothing to do with each other. And in theory, I could assess the risk of both individually. And that's why the unit of account rules exist. They could say segment that. But what most tax people learn is that actually creates more work. So they're like, let's not go ahead and segment that. And I think that as a practical matter, what most people would say is, gosh, by the time I get to negotiating these things with taxing authorities, I do it as a bundle anyways. So there's one R&D credit, one settlement. Let's just reserve for one thing here and not overcomplicate or overthink it. Okay. The takeaway from this slide, though, is in theory, you're supposed to start with a broad, cast a broad net on this thing. Okay. Okay, so I mentioned before recognition. Okay, you've identified your positions. You're like, these are all the things that could go wrong. And now you're supposed to run all of them through this filter for, if I just sat there and thought from a theoretical perspective, or the language that's used here in the slide is based solely on the technical merits. Right? If I just kind of cracked the book open and I looked at my position compared to what I think the law is, am I going to win? Do I have a 50% chance, a greater than 50% chance of winning? And one of the things that was vague about the pre-FIN 48 rules that they have made very clear is that you're supposed to not assume that there's detection risk. So before FIN 48, people would be like, well, how do you even know I'm going to be audited? So maybe I don't need to reserve for it because I'm not going to get audited, so why would I want a liability set up for that, right? And that's not helpful to the reader of the financials to know that you're just guessing as to whether you're going to get audited, right? I mean, that's pretty loose accounting. And so FIN 48 came out and said, assume you're going to get audited. And they said, assume that the auditor has knowledge of what the facts are. And they said, assume you can't horse trade issues, like you can't trade your, transfer pricing for your R&D credit. You're supposed to kind of look at them individually. And so that's kind of an ivory tower type of analysis, because that's not the real world, right? The agents don't have all the facts. And in reality, detection risk is a big deal. So all these things they make you assume, these are theoretical things. This is not real world, but that's how the accounting is based. So you have to pass this recognition test if you want to keep going and not reserve the whole thing, and you have to use those assumptions. Okay? So again, take your R&D credit. You have to say, I have to assume I'm going to get audited. I have to assume the agent knows my facts. I have to assume I'm not going to trade it for some, like the R&D credit's a loser, but I'll keep it because I'll give them something else. I can't assume that. And I have to just apply technical law as it exists to my position to see if I'm going to win. Right? That's the basis on which I'm supposed to get past the recognition test. All right, we good with that? So if you pass the recognition test, then you get on to measurement. Okay? And like I mentioned before, measurement is you basically saying, okay, you basically concluded that you're going to win from a technical perspective. But now, you have to assume, again, you're going to be audited. The auditor has knowledge. You can't horse trade. But, okay, and so this is where things differ. So here's where you can say, well, all relevant facts, circumstances. So now you can take into account other facts. And that could be things like, well, my agent wants to retire. Or, this agent is really aggressive and they're going to get me and I should, anticipate that. Or one of my other, peer companies that's very similar to me went through this situation and they reserved and settled at this, outcome, and so I should probably take that into account because that's kind of a good benchmark to take. So these are like very subjective, contextual type facts that play into the real world a bit more, but of course the extent to which you take these into account is going to create variability between companies too, right? So if one company says, I have an agent that's sharp and is really going to get me, and the other company says, this agent can't find this issue, so I'm going to take those facts into account, you can get different answers, right? But that's the point of measurement. The measurement is meant to, and I don't mean to focus it on the agent so much, but it could be whatever the facts are out there, the extent to which it's disclosed, or the magnitude of the issue, or the pace at which you're trying to close your audit, or your relationship with the audit team. I mean, all these things play into account. And measurement says, all right, include those. Now, here's kind of the zinger with FIN 48, and this is one of the most confusing things, but this will be one of the last theoretical things we talk about. It's this probability table in the lower left corner. Okay, so here's how measurement is supposed to work if you read the guidance. You are supposed to first define your outcomes. Okay? These are outcomes, meaning, let's use my R&D credit example. I claim an R&D credit on my return of $100. Well, I could win all $100. I could settle at 80. I could settle at 60, 40, or 20. Right? And those are pretty much arbitrary outcomes. But in theory, the first thing you're supposed to do is identify what could happen. Right? So Amanda goes back to work at the FTB. She comes and audits me. I'm trying to anticipate what's going to happen. And I come up with these 5 scenarios for some reason. But they're supposed to be intelligent, right? Like you're supposed to use some kind of rational basis for why these are the scenarios. And it doesn't have to be 5. It could be 25. It could be 2, right? It just has to make sense given whatever your situation is. So that's the first thing that you do. Oops, that doesn't even remotely look like a 1. Okay, the second thing you're supposed to do is come up with the individual probability of every outcome. So the chance that I'm going to win $100 of credit is 15%. The chance that I'll settle at 80 is 20%. Right? And so somehow you've assigned odds to these outcomes. How you do this, right, is tricky. Yeah, you know, it's finger in the air, it's guessing. But in theory, if you have a lot of experience as a tax person, you should be able to do this better than, you know, somebody who doesn't have experience, right? This is where kind of the experience plays into things. Also factoring into this is your willingness to fight, right? If you say, like, that 100 of credit, that was gold, I don't know why anyone would have a problem with it. If anyone disagrees, you know, they're nuts, and I will fight to the death. So if that's the case, then, you know, your percentage probability for that first outcome is probably high. Where if you said, I have no patience for this, I will give them half the credit, I don't care, I just want to move on, well then you will rank your percentages accordingly, right? You'll factor that sort of thing in. So you're supposed to assign individual probabilities, and then the third step that you're supposed to take is do the math, okay? And this is just math. And the way this works, this cumulative probability concept, is as follows. So if you were going to say that there's a 15% chance of you winning 100 and a 20% chance of you winning 80, then that must mean that there's at least a 35% chance of you winning at least 80. Is that clicking? Right? So if there's an individual chance of you winning 80, and that's 20%, and there's another 15% chance you'll win more than 80, there's a 35% chance you'll win at least 80. So if you say there's a 20% chance of getting 60, then that means there's a 55% cumulative chance of you winning 60, because you might win 100, you might win 80, and you might win 60. And if you combine those individual probabilities, there's a 55% chance you'll get 60 or more. Are we getting the math? Okay. So the first outcome you get to, where this is greater than 50, that is what you book. Okay? That is how the rule works. You are supposed to find the outcome that is cumulatively more likely than not, and you book that. So that is confusing, right? I mean, I think most people, and this is how IFRS works, which is the International Accounting Standards, it's more of one of these like best estimate types of things, right? You just kind of pick your number and you think, where am I going to come out? And you book that, and it's much more common sense. Whereas the FASB rules have this cumulative probability concept. Now, as you can imagine, you know, companies might start with the answer in mind. They might start with, well, I want a 40% reserve, so now I guess I got to, you know, reverse. Oh my gosh, I don't know what I just did. I got to, you know, work on this probability column in the middle here to figure out how I'm going to get there. And I'm not saying that they're, you know, abusing Fin 48 or anything, but I think they often start with what they think the reasonable answer is, and then they define that in the form of a probability table. And what you see a lot of times is you see a table like this with 3 scenarios. It's like I win, I settle, I lose. And they'll just assign a high percentage to the settlement outcome. And you get to the same place. But it demonstrates the whole cumulative probability concept. But it's very theoretical, right? Most tax VPs are not sitting there trying to assess their cumulative probability. You know, they just kind of hang back and think, well, what am I going to walk away with? And they don't go through the individual probabilities and do this whole exercise. But this is audit documentation. People have this in their files. Okay, so key takeaways. So recognition, right? You have to say you have a winning position or you reserve the whole thing. Measurement, this is you saying, okay, I think I'm going to win, but now I got to figure out what's going to happen when I get audited. Where am I going to walk away with at the end of the day? Okay, that's the key takeaways. All right, let me just pause there. Questions on that? Okay. Okay, I'm going to start speeding through this. Classification. So if you decide you need a reserve, you book it as current or non-current based on when you think you're going to pay it. Okay? So what if you don't think you're ever going to pay it?
Never book it or don't book it?
Well, if you booked a reserve under the recognition and measurement and you don't think you're going to pay it, you don't expect to pay it within a year, so therefore it's non-current. Most people's liabilities are non-current. Before the adoption of FIN 48, I don't know that anyone thought of the concept of a non-current tax liability, but now oftentimes you'll look at a company's balance sheet and it'll be called out separately. Like you'll actually see it on the face of a financial statement. You might even have seen it on Cadence because the reserve, the liability was so big that it might have popped up there. So if you ever see a liability called non-current taxes on a balance sheet, that's almost inevitably this. Okay. If you book a reserve, the rules basically say you have to accrue interest and penalties as the law applies. So interest just happens automatically, and the way financial accounting works is if you have a reserve, you have to anticipate what will really happen when you get audited and you settle at that amount, and that would mean that you'd have interest and maybe penalties. You'll see in a little bit when we talk about disclosures that you actually have to disclose your interest and penalties separately. So for companies that are accruing penalties, they actually have to say, I'm accruing penalties, which usually makes people feel nervous. And so that's been one of the reasons that people are more conservative with their tax positions, because they don't want to be transparent in that way to readers. But interest and penalties, it's required, it's mechanical. And as you look at companies that have big reserves, look at their interest and penalties and see what they're on the hook for in addition to tax. See how that liability grows. That table we focused on when we were reading Cadence's 10K, where we did that roll forward of what they owed, that did not include interest and penalties. That was just tax. Okay? So when somebody says you have a UTB, that's tax. When somebody says you have a liability, that's all the things you owe, including interest and penalties. Disclosures, you have to say all these things. You'll learn all about that in the next class and with your homework. And by the way, the disclosure you're going to read next week is into it, and they have one of the most kind of easy to understand disclosures for a big company out there. And so I think you'll, especially after looking at Cadence, you might say, oh, like this one makes sense. Theirs is fairly easy to process. Okay, so simple example. I don't know that this is necessarily the way this works in the real world, but in theory, what companies would do is they would line up their tax return and compare it to what their outcomes are on a more likely than not basis and compute the differences. So for example, like very easy, we claim on our return that there's an add back for meals and entertainment of $150, but we go through our recognition and measurement analysis and we realize, I probably should have added back more, right? So that difference, this is the amount that we're going to reserve, and this is a pre-tax number, but that's our exposure we've identified by comparing what we did on our return to what we probably should expect as the ultimate outcome. So it's that comparison that will give rise to our UTBs. And we have one permanent item and we have one temporary item. Right? So our meals and entertainment is permanent, and our depreciation is a timing item. So, yep.
What are you saying? The fact is the difference between the 150 and the 300. And the fact is that there's misclassifications.
No. So that difference could be you interpreted the 274 rules differently than the government might interpret them. So, for example, like if I take Susie out to lunch and I try to sell her tax work, that's meals and entertainment subject to this rule. If I work with Susie and she has a birthday and we bring her a birthday cake, that's not subject to the limitation. So those are black and white examples, but maybe there's something in between. Maybe I bring her a birthday cake and I try to sell her work, right? So where's that? I don't know. But there's shades of gray, right? And that might be what this 150 is, something like that. So we have a permanent item, which is if I get audited and they say, oh, you should have added it back more, I have to permanently pay more tax. With depreciation, if I deducted $2,000 and the taxing authorities say, I think you overdid it, I'll just get that extra later, right? So it's a now versus then sort of thing, as opposed to an ever versus never.
So when you do this, though, when you do your tax return, then you do all this more likely than not?
You do this when you're doing your provision. So if you're Tracy and you're sitting there in January and you're calculating a provision, you have to put your anticipated return next to what your ultimate outcome is going to be, essentially. So you do this when you're doing your provision, not when you wait until you file your return. Okay?
But you wouldn't do this after you know the set the report?
You could true this up, for example.
Yeah, you
right?
could true up.
You always true everything up, but you need to spot these things when you're doing your provision originally, right? So year-end provisions are about to start hitting, or people are building up for those, and so they will start thinking, what positions do I have for 2012? What do I need to reserve for? What am I going to do on my tax return that's going to cause exposure? Let me plan for that now.
Has anything like worried them about, what was it, RV wasn't reenacted or something like that?
Not yet.
Not yet, so do they just assume the government's always done this, the probability thing?
We'll talk about that at a different time.
Okay.
Okay, so if we were thinking of journal entries and how to book the FIN 48 effect of this, you kind of have to follow the numbers here a little bit. But the payable on a return basis is the $66.62, and we would owe $403 more on a FIN 48 basis. So it's a little hard to follow without seeing everything. But that 66.62 right here, that's the credit to the liability you'd book if you were doing your provision on a return basis. And this is the extra 403 you book for your FIN 48 liabilities, or that added exposure, right? And you can see, let me just focus on the bottom entry, the effect of the permanent difference, that $150, that's finding its way, the balancing entry for that is in this 53, right? The $150 probably times a 35% tax rate, right? So if you had a $150 exposure and a $35 tax rate, that's 53 of tax. And so essentially what they're saying with that entry is I'm going to credit my liability 53 and I'm going to debit my provision 53. That's my extra FIN 48 entry. And for the timing difference, the depreciation, they're saying, well, yeah, you might owe more tax, but in the future, you'll get it back. So we'll book a DTA for that on a FIN 48 basis. So you can think of this as, you know, kind of your as filed, and this is your extra FIN 48. Like, what do I really think is ultimately going to happen, right? I first book my provision as I file it, and then I book some extra entries based on what I think is going to happen when I ultimately get challenged. Okay? So this is a little like that non-GAAP stuff we were talking about, right? There's the tax accounting I'm booking based on what I really do, and then there's kind of that other made-up land that this is kind of what I'm guessing might happen, and I think it's prudent to book based on an expectation of ultimate outcomes. All right, we getting that? Okay. Well, hopefully you'll get it through the problem. We're going to go through an exercise in a second here where we'll challenge that.
You're saying the DTA is essentially a plug?
Well, the DTA is not a plug. The DTA basically represents, look, if the taxing authority comes in and says you depreciated too much, you owe me more tax, then you'll just say, okay, well, fine, it's depreciation, it's timing. If I don't get it now, I get it in the future. So fine, I'll accrue more payable, but I also have to accrue a DTA now because you're saying I'll get a future deduction. You can't have one without the other if it's a timing item, is the point.
So you would go through this as well whenever you do a provision to return?
Absolutely. You would go through this whole page and you would do it again based on your actual facts. Yeah. Okay, so I'm going to blow through some of these. Okay, so the last thing I want you to know before we go do an exercise is, if you're a company and you decide you need a reserve, okay, you go through recognition, you go through measurement, you decide there's a liability here, I should book it. Now for companies, and this was new starting in 2010 for returns, now you have to file this form called Schedule UTP with your tax return and basically tell the IRS, hey, I booked reserves. So if you were the IRS, you're like, that's helpful. I'm going to focus on those, right? Because you think you're going to lose. I might think you're going to lose. And so you have to file this form that basically provides a little bit of information about what reserves you booked. And the idea is that this is helping the IRS be more efficient because rather than like hunting for issues, they can spend their time actually getting to the right answer and, you know, doing less of this like playing chicken about what the issues really are. Okay? As you can imagine, if you're a company and you're sitting there 5 years ago and you're trying to figure out whether or not to book a reserve, you might decide based on a certain sort of dynamic, but now throw into the mix, if you reserve, you have to show that on your tax return. That's a different dynamic, right? And so now you're thinking as a tax VP, I may not want to reserve anymore because if I reserve, I have to disclose it, and if I disclose it, that's going to increase my chances of getting audited, or if I'm already audited, I'm going to increase my odds of having an assessment on that position. So I don't feel like reserving anymore. And you know, there have been some articles out in the tax press around behavior changes because of this new rule, and there's no question that anecdotally people reserve less because of this rule.
And which of this rule happened?
The first year people did it was with their calendar 2010 returns. So the returns that just got filed, it was the second year. And some of the statistics that came out was like the average large company filed, I think, like 2 positions when they filed their form, which seems very low, right? You're taking large companies and saying there's only 2 things you reserve for a year. And there was a very high degree of commonality what the positions were. They were transfer pricing and R&D for the most part. And almost every company in the Valley has reserves for transfer pricing and R&D. So it was one of those things where there was a ton of energy poured into it, but I'm not sure exactly like if there was a huge payback for the government. But I sit in rooms with tax VPs all the time, and they will say, you know, if we're talking about an exposure area, they'll say, well, I'd have to disclose that, right? And if you say yes, then their mind starts thinking, okay, well now I have to think about whether I like that. And that would have not been a conversation 2 or 3 years ago. They would think of reserves in financial accounting terms, but not in what it means to their return. Okay? Amanda?
What happens if you don't reserve enough for financial?
What happens if you don't reserve enough for financial statements? Well, you'll have to pay more, right?
I mean, is there like a threshold where you might have to restate, or I don't know, is there SEC would get in trouble if you're a company that you didn't specify enough?
So one of my clients, I mean this is public knowledge, is a company by the name of Power Integrations. It's a semiconductor company, and in their second quarter ended June 30th, they settled with the IRS on a big issue, an international tax issue, and they had accrued 20-30 million for the exposure, and they paid 10 million beyond that. And so in last quarter they booked a charge for 10 million, and they said, turned out we had to pay more than we thought. And they didn't restate. I mean, restating is when you basically got the facts wrong before. So they would say, well, I thought I had it right before. I thought I had the right settlement. But you know what? This audit went on for 5 years. It was killing us. We were done with it. We're not a huge company. We're basically like paying lawyers and then paying more lawyers. And we're ready to just move on. And so we settled. And in their disclosure, they basically said, we're taking this large charge. Here's why. Here's why we closed the door on all this kind of bad news. We've moved on. We're in great shape. And so that happens from time to time, but that's rare. Most times companies over-accrue reserves. That's the opposite. And the reason is all those assumptions, right? You're supposed to assume you're getting audited, supposed to assume the agent knows what's going on, you know, assume you can't horse trade. All these things you're supposed to assume that aren't real world, but they all increase the likelihood you have a bigger reserve. Okay, that's normally what happens.
So since taxes has to do with estimates. You don't have to, you almost never have to restate your financial.
That is not true. Timmy's question was, because taxes are estimates, does that mean you almost never have to restate financials? And I don't have the statistics at my fingertips, but I want to say tax is like one of the #1 reasons for restatements. And it has less to do with these reserve issues and more to do with the fact that provisions are complicated and people just had an aha moment they were getting it totally wrong. And so you'll see, like when we get into complex problems, that you'll be like, oh, I'm stuck, or I got it wrong, or it's entirely possible just to do things wrong for a while, and then let's say, you leave the company and, Susie starts and she's like, I don't know what Timmy was doing, but that was wrong. And boom, you got a restatement, right? That's what happens. So new internal team, new external auditors, new advisors, or just a general epiphany, then boom, that's what causes restatements. Yeah, Jesse.
So usually after the company settle, will they lower the reserve right away next year, or do you keep the same reserve?
Okay, so ask your question a little louder one more time.
When the settlements occur, does the company usually lower the reserve, or they keep the same reserve?
When the settlement occurs, do they lower their reserves? And I think what you mean, so let me use my R&D credit example. So you take an R&D credit of $100 and you think you're going to reserve 20 because you might lose 80. And let's say that the auditor comes in, you agree on 85. So in that situation, you pay him 15 and you pop the 5 as a benefit, right? Because you had excess reserves, excess liabilities, and you would flip those into the P&L when you settled. You would say, kind of like Cadence, I went to appeals, I settled, I won it, more than I thought I was going to win, so that 5 becomes a benefit. Does that answer your question, though?
So that's the treatment for that year item.
Oh, so you're saying, like, I had an R&D credit next year, too, so do I take that 85% settlement outcome into that? And the answer is it depends. So I have one client who, for their IRS audit on their R&D credit, they do that. They say, looks like 15% is a good haircut because they did a legitimate audit. I feel like I got to a settlement percentage where I think I can apply that in the future. But on their California audit, they said the opposite. They're like, well, we went through an audit and we got an assessment, but that was kind of not probably indicative of what's going to happen in the future because that was kind of a weird audit. So you can take it into account if it makes sense, but this is where judgment comes into play. Okay. All right, enough talking. Man, I'm exhausted from talking. I can tell you guys are exhausted from listening too. I can only imagine your faces while you're sitting there watching videos. I should sneak in one of those, like, I can see you sleeping now. Okay. So we're going to do in-class exercise 1 now. And I am going to stop the video, or actually just pause it so we can go through the answer together. And so work as a group and go through in-class exercise 1. And this is a pretty basic provision. I mean, it doesn't get into the... Let me make sure I'm looking at the right one here. Yeah, okay, so this is the one that says Big Tom Boone and Company. So I give you a bunch of facts, and a lot of this is really just rehashing the same provision stuff we've learned in the first couple classes, but there's a little FIN 48 twist at the end, and I just want you to mostly reinforce some of the provision stuff we've been learning, but then also layer in a very simple FIN 48 twist. Okay, that's the goal here. All right? Okay, so we're going to go through the solution to in-class exercise 1. Okay, what do we do first? State. Yeah, good, Lewis. State, then federal, right? Okay, so Jesse, we're going to do our state provision, right? I'm just going to create like one more page here.
You're blue.
Oh, I'm blue? Okay, sorry. Well, it'll take the video, I guess, so you just can't see it. I was IMing with Tarek. You saw him pop in earlier, and he was making fun of me for teaching class. And so I told him he was at one of my clients. He was at Amazon, and they have a provision question. So I told him I would conference you all in, and we'd have like group think on their problem, you know. All right. Anyway, so we're going to do the state provision. Okay. So Jesse, how would I do it if I'm going to do my payable?
So you start with the BUS first.
Okay. I think you probably have to talk louder because I doubt An can hear you.
You start with the book income of $1 million.
Okay. Book income of $1 million.
And
Okay.
then go to the 10.
An, can you hear?
Sorry. There will be no perm in this calculation because state does not allow tax exemption.
Okay, but if it did, what would be your perm? 50,000. I think most people assume that it was tax-free, so I'm going to let people kind of assume that, and that'll keep momentum. Plus, the solution has it that way, and so to avoid thrash with the solution later, yeah. You'll see this will happen like on the midterm too. You'll be like, what am I supposed to assume? And I don't care what you assume, just get it right based on what you assume, and then that's good enough. Within reason. Okay, so we're going to deduct 50,000 because we're going to say that's a permanent interest, tax-exempt interest. Okay, what do we do next?
Now we go to 10.
Okay.
We add back 80,000 for inventory reserve.
We add back 80,000 for inventory reserve. Okay, so that's inventory.
And then add back book depreciation for 20,000.
Book depreciation for 20,000. Okay. What else? That's taxable income. Okay. Okay. And what's our state tax rate?
Then we take the blended apportionment of 80% for the first state.
So we have state 1 with a apportionment rate of 80% and a tax rate of 5%. So that's effectively 4%, right? We have state 2 with an apportionment rate of 30% times 10%. And that's 3%. So in total, we essentially have a 7% state tax rate. Okay? So some of you will ask, why is the apportionment not add up to 100? And the answer is because different states use different rules, and it doesn't add up to 100 sometimes. Okay? All right, so we have 1,000 or 1,050,000, and we have a 7% tax rate. What's that? $73,500. Okay, that's our step 1 payable. Right? Okay. So what are we going to do about deferreds? So that's step 1. I'm not really following the questions per se. I'm just doing the whole provision as if I was doing it. Okay, so I do my step 1. I credit my payable 73.5. So my step 2 is to figure out my deferreds. So Carol, let me pick on you. What are our deferreds?
Inventory reserve and
So we have this causing a DTA, that causing a DTA, right?
yeah.
Okay. The sum of those is 100,000. The tax rate is 7%. So I have a DTA of 7,000, right? So Carol, do I debit DTA or credit DTA? Good. I debit my DTA 7,000. Okay. Wenju, what do I do next? Not last time I checked. My entry doesn't bounce.
Oh. You have to the difference between
right? Okay, I'm done with my state provision. We good with that? That's the easy part. Okay, so we have a state payable of 73.5 and state deferreds of a 7,000 asset, right? Okay. So now we're going to go do our federal provision. Okay, Crabe. I always feel like I'm saying that wrong. Is that close enough? Crabe? Capre. See, I wasn't even close. Oh. All right. Capre. Okay. So if I was doing step 1, what would I do for federal? Well, I can probably start with that $1,050,000, right, that I calculated for state. It's probably the same, right? I think so. So I start with the $1 million of book income, perm difference for tax exempt, temp difference for depreciation inventory. I get to the same 1050, right? So my taxable income is 1050. And I said that my state taxes I'm going to deduct on a lag basis, right? So like California works this way. So if you pay California tax in 1 year, you deduct it the next year for federal tax purposes. So we're not going to deduct it this year. We're going to deduct it next year. Okay? Isn't that what I said in there? Oh, my... So yours doesn't say? Do we take... It's on my version. Do we take it off or leave it? Let me see what you say. Whatever you have it. Yeah, we deleted it, but we have the old one.
He's doing a different problem.
Yeah, exactly. Duh. Okay, so now we're truly like free living it. Okay, so we're going to start with $1,050,000 of taxable income, and now I guess we're going to deduct 73.5, right? Okay, so I don't have a calculator handy. You guys are going to have to tell me the math.
It's 976,500.
976,500. Okay, and we've got a 35% tax rate. So what's that?
341,775.
341,775. Okay, and then Crabe, what did we do next? We calculated our tax. What do we do next?
We have to deduct the federal R&D credit.
And how much is that?
20.
Is it 10 or 20?
I'm blind.
That can't be too confusing. Okay, so that would give us 331,775, right? Okay, so if we're coming up with our journal entry, we're going to credit our payable 331,775, right? Okay, our deferreds, so that's step 1, right? So Jing, what are our deferreds? You can cheat with Uncle Sam if you want to, it's fine. Okay, what deferreds do we have for federal?
The same numbers.
If you're talking, I can't hear you. I'll give you a hint. It's written on the board. Although messy. Uncle Sam, save her.
73.
Janie, save them. Iceberg ahead. She said what? I didn't hear what she said. I'm sure it's good though. She can't read my handwriting? That's all right. In my notes where I took about you guys, there was one person I can't read the handwriting, and every time I look at it, I'm like, what did I write? Depreciation is the first one, so I will help you. So depreciation was the 80,000. And inventory reserve is the 20, I guess, right?
Yeah.
I'm just doing this by memory.
It's not way around.
Well, whatever. It doesn't matter. Okay, what other deferreds we have? We have depreciation, we have inventory, we have one other thing. What's that? DTA. What does that mean? If you watched my extra lecture, we have state DTAs. So what do we have? Means we have a state, a federal effective state, right? Fed effective state.
Is that the one you said you changed sign?
Of 7,000, right?
You changed the sign.
In the future, when we save 7,000 of state tax, we're not going to get 7,000 of federal deductions for state tax, right? The way I think of it is, ultimately, the way the provision ought to work is we're going to get to deduct our state provision of 66.5. We already deducted 73.5, so we have 7,000 going to come back the other way someday. Okay? That's the way to think of it. Okay, so that's 93,000. 35%. Someone with a calculator. 32,550? 32,550. Okay, that is our DTA. We are going to debit our DTA. 32,550. Okay, Wenju, what are we going to do next? I know, I'm most of the way through it. Same answer as last time. Balance the entry with the provision. Wenju, you're going to have to sit closer to the front next time. You have a third. Exactly. Okay, so if I balance the entry, what's that number? Somebody talk actually loud. Say it, Dan. 299,225. 299,225. Okay. We good with that? All right. Kunal, is this what you got so far? Ha. Is that a... Okay, so our total provision... You guys just assume I'm right all the time, but I could have goofed something. And so our total provision was federal 299,225, and our state provision was 66,500, right? So that's 725 and 5 and 6 and 3. 365, 725, if I did that right. Okay? Is that what you got? Now?
No.
What's that?
I have forgotten the argument.
Ah, okay. So let's do the rate rec then. Okay, so Amanda can do the rate rec because she's probably already figured it out. All right? Okay, so we're going to start with PBT of $1 million. Right? So what would we expect our provision to be, Amanda? This is the easy part. No, what would we expect it to be? We're going to start with a number in mind, and we're going to reconcile to what our answer is. $350,000. And then we're going to get to 365,725 unless things go south on us. Right? Okay, so how do we get there? Still you. I don't think you've really gone yet. Tax exempt interest. Okay, so we're going to call that interest. And that was 50,000. So at 35%, that is 17.5, right? That's a good guy. Okay. So far we're going in the wrong direction. State taxes. Okay. How much was our state tax provision? 66.5. Okay. And we should get a Fed benefit of state, right? So what's 35% of 66.5? 7,000 is definitely not 35% of 66.5. 23,275. Okay. Does that foot? I don't think so.
No, it's because 75 down the bottom.
Tax credit?
Tax credit, right? Okay. All right. Does that foot? 40, 50. That looks like it's gold to me. Yep.